All right, good morning, everyone, and welcome to Sax Wealth Advisors Year-End Tax Planning and What You Need to Know Now webinar. Thanks for everyone who's taking their time out of their morning to join us. Before we begin, I have a couple housekeeping items. First is this webinar is being recorded, and we will be posting our slides and the recording in the next few days, so you will be able to watch it again if you need. Please submit any questions as we go. We plan to have some time at the end of our presentation to answer questions, but if we run out of time or do not get to your question specifically, one of us will follow up with you directly. Our firm provides this information in this webinar presentation for general guidance only and does not constitute the provision of legal advice, tax advice, accounting services, investment advice, or professional consulting of any kind. The information provided herein should not be used as a substitute for consultation with professional tax, accounting, legal, or other competent advisors. Before making any decision or taking any action, you should consult a professional advisor who has been provided with all pertinent facts relevant to your particular situation. My name is Greg Munn. I will be the moderator today. I am a CPA and a certified financial planner at Sax Wealth Advisors. I'm joined with a couple other amazing colleagues, and they will introduce themselves.
Thanks, Greg. Hi, I'm Joy Matak. I run the Trust and Estate team here for Sax. I'm very excited to be with you today. I am an attorney by trade, but I am privileged to work with really great professionals in the accounting space, including my colleague Craig Cassano, who I'm going to introduce now.
Hey, Joy, Greg, thank you. Appreciate it. Happy to be on today. My name is Craig Cassano. I'm a tax director here at Sax LLP, also a CPA, and I co-lead the private client practice here, which focuses primarily on high net worth individuals and their families, and looking forward to speaking today. Back to you, Greg.
Thank you. So today's agenda, we'll be going over a few different items. First, why estate planning should continue. We'll look at any sort of charitable planning strategies, talk a little bit about state of residency and how that could impact you. We'll get into how portfolio allocation can benefit you tax efficiently, discuss some year-end capital gain distributions, as well as any RMDs, Roth Conversions, etc.
Thanks, Greg. So, of course, I'll be taking the lead here on the estate planning side because this is pretty much what I do here at the firm. I work with our clients to talk about different options that they might want to consider. I will say that the last 6 weeks have been a little crazy for in the estate planning world. Some of you may have heard that there was a proposal to reduce the lifetime exemption from $11.7 million per taxpayer down to $6 million starting on January 1st, 2022. I can now happily say that it appears that that is not going to happen, although it's hard to really pinpoint what's going on down in Congress. So stay tuned for that information. But if you're a taxpayer who has an estate combined with your spouse of about $15 to $17 million, you probably can hold off on substantial tax planning unless you want to talk about different things that you should be doing anyway, because estate planning really should continue. It's an important aspect of what people need to be thinking about, and there are different things that some of us mere mortals need to maybe consider. By way of example, one of the things that you should be doing is checking those beneficiary designation clauses on your retirement accounts. They're not all beneficiaries are created equal. Generally speaking, it's better to name your spouse as your beneficiary, but if that's not an option for you, we should be talking through different ways that you might want to leave your assets so that you don't get hit with a significant tax pinch, or that your heirs don't get hit with a significant tax pinch. Perhaps you want to consider gifting. For 2021, the amount that you could give away to every person was $15,000 per person. So Greg, I know that before this started, you asked how much you could give to Craig. If you wanted to make a tax-free gift, it was $15,000 for 2021, but the IRS has just released its inflation-adjusted numbers, and you can actually, if you wait until 2022, you can give him $16,000. So, I'm sure that Greg will be very happy to receive that check.
Beautiful.
You might
Maybe I
also,
can do some in December and January.
there you go. See, that's $31,000, and that's quick math that I was able to do in my own head. You also want to look at the life insurance that you might own. Usually, it's better to have life insurance on your own life owned in a trust and not outright. And that's because the way estate taxes work is we take a picture of your assets as of the moment of your death, and we determine what the value is, and that is what the tax is assessed on. So if you have an estate of $5 or $6 million, and you have a $6 or $7 million life insurance policy, and you own that on your own life, as of the moment of your death, you now have a taxable estate for federal estate tax purposes. Because if I were to do the math really quickly, you would have an estate worth about $13 million on your death. Not a good position to be in, because that life insurance probably was not intended to go partially to the IRS. So that might be something that you want to be looking at. One person actually sent in a question about revocable trusts, and I did want to address that. That's a very good question. During the pandemic, one of the things that we saw was that the courts became clogged, and it became very difficult to probate estates. That's where you take somebody's will and you go to the courthouse and you get certified as the person who's eligible to speak on behalf of the estate. That became a very difficult and arduous process in places like New York and New Jersey. So even though probate usually, or prior to the pandemic, had not been an issue, it really became something that hamstrung a lot of people. And what would happen is that because these people were not able to go through the court process, they couldn't even do anything with the brokerage accounts. And that was really significant for people, because the assets were just kind of sitting there in the brokerage accounts. You couldn't sell them, you couldn't move them, you couldn't do anything that might have been a good move in order to get some of those gains in the market that we saw during the pandemic, and people really could lost out. So a better alternative would be to set up a revocable trust and transfer assets like a brokerage account into it, so that as of the moment of your death, there's someone ready to step in. That trust and the assets in it does not have to go through probate. There's no process by which you would have to go to a court and get permission to act on behalf of the trust. In that case, the formerly revocable trust that becomes irrevocable on your death, right? So a revocable trust stands in the place of a will. You don't lose access to those assets. They're still part of your estate, but you get the opportunity to create a vehicle that is easier for people to manage after you die, particularly if there's some disruption in the court system that could potentially hurt that person's, your purported person who's going to act on your behalf's ability to do that. So a revocable trust that we found is a very good vehicle, and something that people should be considering. Additionally, you can make, you can benefit your heirs. So a lot of grandparents will call us and say, hey, I can't, make $10 million worth of gifts. So there's no tax planning that I'm really considering, but I'd really like to look for different ways to, use, make transfers, make gifts, benefit my grandchildren. And one of the ways that they might want to do that is to pay the college expenses, pay the educational expenses directly. This only works if you write the check directly to the bursar of the college, or in the case of paying for someone's health expenses, you would have to write it directly to a hospital or medical provider, whoever the provider was for that service. But there's no limit on the payment of those expenses, so long as they're valid expenses and that they're written directly to the provider of those services. So that's one way that you can benefit someone without making a gift that would have to be reported on a gift tax return. Additionally, grandparents like to accelerate their gifts by making 5 years worth of 529 gifts. So a Section 529 plan is an educational plan that allows assets to grow income tax free, and then it's for basically a brokerage account, and the income, it grows income tax free and then can be distributed out to pay for education. So you can accelerate your $15,000 per person per year by making a $75,000 contribution to a 529 for an individual beneficiary in 2021 before the end of the year, and that will not count against your lifetime exemption. So these are some more simple estate planning ideas that we see people considering, and some things that maybe some of us mere mortals who don't have 60 or 70 million dollars hanging around might want to consider. Greg, can you advance the slide, please? So the 2021 exemption is $11.7 million per person. That's $23.4 million per couple. And there are ways that you can use some of that, and we're helping people to use some of that without hurting or without losing access to it. Because giving away $10 million, $11 million can be financially burdensome, obviously, but because you actually have to give the asset away. And I think this is really where, we talk about all these fancy transfer tactics and these fancy terms, and we say, oh, it's really good to use up your exemption. The problem is that if you're using up your exemption, but you don't have access to those assets, it could be a problem later on. But you do have to be willing to give it up, at least for some period of time. So we do have some flexible planning alternatives that we can discuss with you if you're interested in making a large gift, and we're happy to discuss. One of the things that I also see clients kind of falling short of is confirming their cash flow. It's important to know that you're going to be able to live on the assets that you retain after you make the gifts. We can help you with that as well. Can you advance the slide, please? We don't know what's going to happen this year. There's the Build Back Better plan proposal, which is still bandying around Congress. There's a lot of people posturing, different legislators who are saying different things. It could potentially, there could be some return to a lowering of the exemption. We don't see that currently, but stranger things have happened. There has been significant stimulus spending and pandemic losses, which have crunched federal budgets and exploded the deficit, which does make tax increases likely. Another thing that we wanted to make sure to talk about is it's important to structure trusts so that you have the flexibility to be able to take advantage of income tax advantages at a later point. So if you are doing tax planning, something else we want to be talking about. Please advance the slide. And this is really where it becomes important to have a collaborative approach. We all want to be working together, to get you the best results. It's not a good strategy to just go it alone or go with just one type of advisor. When we're all sitting at the table, we're able to lend our different perspectives and make sure that you're getting the best planning strategy. There are some charitable structures, some more complex structures, and I have some slides here that you can consult at a later, at your leisure. If you're bored one night and you want to see some different charitable planning structures, you could certainly look through those. And we'll talk a little bit about, actually, if you could advance the slide, that would probably be good. Yeah, so here's some planning strategies that I like to talk with people about. Charitable trusts are a good alternative if you are charitably inclined and already making significant charitable contributions. Generally, it's better to make charitable contributions during your lifetime because you're going to get a better income tax benefit. But again, sometimes you're just not able to make significant charitable contributions up front. So we do like to look at charitable remainder trusts, which allow the donor to move assets that will eventually go to charity, but take back a benefit for a term of years or their lifetime. Please advance the slide. So charitable trust plan, I think they're a little out of order, but that's okay. So can you just advance the slide one more time? Thanks. Annual cash donations are attractive for their simplicity. If you make a cash contribution to a donee, to a charitable organization, you can get a deduction of up to 60% of your adjusted gross income through 2025. And then it will be deductible up to 100% of AGI for 2021. But I think that Craig is going to talk about how this, well, I guess I'm going to say it, how this actually needs to go directly to a charitable organization that would qualify as a charitable entity. You couldn't do it to your donor advised fund or to a charitable trust. Charitable trust planning is generally limited to 30% of the adjusted gross income. Please advance the slide. Yeah, so donor advised funds, I'm not sure if Greg or Craig want to weigh in on this, but the advantage of making a transfer to a donor advised fund is I'm not really ready to make a significant or to identify the charity that I want to give to, or maybe you want to delay distributing to a charity because you want to give them $10,000 a year, for example. But instead of only putting $10,000 in 1 year, you put $50,000 in the year so that you get the charitable contribution deduction of $50,000 up to 60% of your adjusted gross income. And then that $50,000 can kind of be held by the donor advised fund and distributed over time. I like donor advised funds better than private foundations because the donor advised fund manager can use can basically meet all the regulations that you would otherwise have to meet if you were to have your own private foundation. Advance the slide.
Yeah, so
yeah, go ahead.
Joy, if you don't mind, I'll hop in just quickly as it relates to donor advised funds. Again, this is Craig Casano speaking here. So with a couple of things to highlight with donor advised funds, I guess just kind of going back to that cash contribution slide for a second, that final point as it relates to 100% of AGI cash contributions, that actually dates to the CARES Act, where the IRS allowed taxpayers to give up to 100% of their adjusted gross incomes to third-party charities. The key thing there, just to continue to emphasize what Joy said, is those contributions must, similar to what Joy was describing with gifts made by folks directly to colleges or even hospitals and whatnot. In this case, the same would apply with cash gifts, where they would need to be made directly to a third-party 501c3 charity as opposed to private foundations or donor advised funds in this case. So just very cautious if folks are thinking about giving up to 100% of their AGI to make certain that prior to doing so, it's being vetted with regards to whether or not the charity is indeed a 501c3. And just to echo what Joy said and be a little bit repetitive here, donor advised funds are preferable over private foundations in a way because, you know, not only do they get more preferential treatment from a percentage of AGI perspective in the years in which contributions are made, but also just ease of administration. You know, donor advised funds, the managers of those funds are handling the filings. There's also, there would be no need for, you know, obviously to keep an eye on the 5% distribution that needs to be made from private foundations. And even though the tax rate on private foundations is small, I think currently it's about 1.39% or so, give or take. Even with that being said, you know, obviously with DAFs, there would be no tax in that case that you would, you know, taxpayer would ultimately be responsible for monitoring and filing returns and so on and so forth. So it really does make it more of a seamless. And what we're seeing a lot of actually is some clients are even winding down private foundations that they have and then rolling them into donor advised funds, which in the year that they do so, that roll into that DAF actually qualifies for the 5% distribution. So it's kind of the best of all worlds. It's eliminating the administration and so on and so forth.
Yeah, I think donor advised funds really changed the game for really wealthy people who are looking, because you can name a donor advised fund the Joy Matok Family Foundation if you want to. You don't have to, you know, you're not stuck just calling it the Fidelity Donor Advised Fund. And I think that, you know, people really want to leave a legacy when they make charitable contributions. A donor advised fund allows you to do that, and also allows you to avoid all of the, you know, all of the regulatory requirements of a private foundation.
Yep.
Yeah. So then, thanks, Craig. So if you advance the slide, we can talk about transfers of low basis stock, which I think we get a lot of questions about. Basically, what you need to know is that it's important that you're transferring stock that you've held for more than 1 year, and you want to find stock that has appreciated in value. So ordinarily, when you have stock that you've owned for more than 1 year that's appreciated in value that you don't want to own anymore, you would sell it and recognize a capital gain, which could be taxed at 20% plus a 3.8% net investment income tax if you're subject to that. By transferring it instead, before the sale, transferring it instead to a charitable entity, and this could be your donor advised fund, or it could be a charitable organization, you can actually deduct the value of the shares without ever recognizing the capital gains. So it is a significant benefit because it both gives you a charitable contribution deduction on the transfer of the shares, and it also eliminates that capital gains, because we're talking about assets that are pregnant with this capital gains tax, income tax burden. You're actually avoiding both the capital gains tax as well as getting a significant charitable contribution deduction potentially. So this is something that people really need to, I think, be aware of as we get to year end and they start to look for ways to make charitable contributions. Craig, did you want to talk about qualified charitable distributions?
Yes, certainly. If you wouldn't mind, Greg, switching. There you go. So qualified charitable distributions, in a nutshell, what this is so with various IRAs, we have what's known as required minimum distributions. And those are calculated in given years based on actuarial tables, life expectancy, and so on and so forth. So what the service allows is for taxpayers' IRAs, taxpayers can distribute as part of their RMD, or even all of it, depending on the amount for the given year, up to 100,000 to similar type charities that we were discussing as it relates to the 100% of AGI limitation for cash contributions. So in this case, it would have to come directly from the IRA, direct transfer into the 501c3 third-party charity, public charity. And just to emphasize there for a second, the 100,000 cannot come to the taxpayer and then subsequently be given to the charity. In that case, qualified charitable distribution would not be allowed, meaning that it would be picked up on the tax return as an actual taxable distribution from the IRA. In so that if it goes directly to the charity, then the way it would work on the tax return is it would be coded as a QCD, or a qualified charitable distribution, and not get factored into taxable income. On the flip side, it would also not qualify in that given year or be deductible as a charitable expense. So it's, you can't have one without the other. And the donation itself is not subject to the AGI income limits, meaning once that 100,000 goes to charity, that does not count towards any other charitable contributions that you may be making, or if you have carryover from the prior year, whatever that percentage of AGI, and we'll get to what that means a little bit later in a summary slide. But basically that 100,000, if all the boxes are checked, meaning it goes directly to the charity, would not be picked up as taxable income. It would also not be a deductible charitable expense, and it would not be subject to the AGI limitations. And just to highlight there, again, it would have to go to a third-party charity, not something like a DAF or a private foundation.
And now I did want to talk and I'm going to talk very briefly because this is rarefied air. This is a very technical trust vehicle, but I did want to talk really briefly about a non-grantor charitable lead trust because it's one of the best vehicles out there now that interest rates are really low, and it kind of works the same way as a qualified charitable distribution in a way, because just like the QCD takes that $100,000 that you would have had to pick up an income and says basically you don't have to report it as income anymore, the non-grantor charitable lead trust kind of works the same way. You take an asset that's earning a bunch of income, probably brokerage account, you take it out of your individual name and you throw it into this vehicle. Now all of that income gets paid to the charity, and it's outside of your taxable estate, or it's outside of your income tax return. So you basically take it off the 1040 and throw it into the trust. So you reduce your income. You're not getting a charitable contribution deduction, but you're taking an income producing asset out, and you're actually eliminating that income from your annual tax return. The trust would then report the income and pay out a charitable contribution to get a deduction for that. So it's a way to kind of, remove income from your personal 1040 and put it to a charity. Maybe that was something you were doing anyway. And if you can turn to the next slide, and because the interest rates are so low, actually go to the slide before it, and because interest rates are so low, the assets in the charitable lead trust will continue to grow. And then because all you have to do is beat that rate. If you grow faster than 1.4%, any growth can wind up going to your kids. So the non-grantor charitable lead trust is a way to get an estate tax benefit while also removing some income from your 1040. So a lot more complicated, sophisticated planning strategy, something we could walk through with you if you were interested in talking through it. This is a good option for people who make substantial charitable contributions on an annual basis. Okay, next slide. So we just wanted to make sure you had this, I think, right, Craig? That was kind of the idea here.
Yeah, so this is the summary that I was alluding to when speaking about QCDs a little bit earlier. And what this is in a nutshell is the IRS allows folks to take charitable deductions in a given tax year up to certain percentages of their adjusted gross income. And for purposes of this example, I'll use 100,000 as our income for purposes of ease and rounding. So just kind of starting from the top there, and for tax year 2021 only, it was also for 2020 as well if folks took advantage of this, but the IRS extended it into 2021 as well. I haven't seen anything that says they're going to extend into 22, so we could assume that 21 will be the last year of this. So basically just going back, if cash to a third-party charity, folks can give up to 100% of their adjusted gross income. So in this example, $100,000 of income, you can give up to 100,000 to charity, wipe away your income completely. Typically in previous years prior to the increase, that number has been 60%. So then that cash amount would have been 60,000. And then as we start to give different assets, to Joy's earlier example of appreciated stocks, we would have 30% of adjusted gross income allowed, meaning growth in say you're holding Amazon or what have you. If you're able to give if with your income of 100,000, you would be able to give up to 30,000, let's say, of fair market value worth of stock. Now switching gears to a private foundation, for example, with cash, it's 30%, so it will be that same 30%. And as you can see, private foundations allow you to give a little bit less of your AGI in a given year. An appreciated stock to a private foundation actually comes down even further to 20%. So in this, $20,000 allowed. And then now switching gears for a second, cash is in that same bucket to the DAF or the donor advised fund. Cash is if you get gross income, but again, highlighting that for 21 year where 100% is allowed, DAFs do not qualify. It has to go to that third party charity. I know I keep saying that, but it's for a reason. An appreciated stock to donor advised fund, that would also be 30%. And just kind of a note, any unused contributions in a given year would carry forward for the next following 5 years. Next slide, please. So one thing we just wanted to touch upon briefly as it relates just overall to kind of the crux of this conversation this morning is obviously things to think about and start doing now is, I think we'd be remiss if we didn't mention tax residency. Obviously with all the chatter in the news and Congress kicking around plans, you know, we're seeing that with respect to potential spikes in tax rates, whether it be in the form of raising capital gains rates or raising ordinary rates or surcharges on incomes that exceed certain amounts, or just our existing tax rates, which are high in of themselves. Obviously, folks living in high tax states, whether it's California or New York, New Jersey, or even Connecticut for that matter, we start to think about whether it be retirement or even now, especially given the world we're in, where a lot of folks are working virtually and remotely. We start to think about and start to revisit whether or not certain states of residency or our current residency makes sense, whatever that may or may not be. But the thing we wanted to emphasize a little bit further is, you know, we know the states in which there's no income tax, just to name a few: Florida, Texas, you know, Wyoming, Nevada. So we may save in taxes, but you know, lose everything on the Las Vegas Strip if we move to Nevada. But the thing to keep in mind there is switching residency for tax purposes is not as simple as just changing some addresses on some bills and or changing a driver's license or where we vote. There are certain things as it relates to both from a terminology perspective, what's known as changing domicile, as well as being mindful of what's known as statutory residency. So there's two separate hurdles that a lot of the states make one jump over if they really check all the boxes to switch their tax residency. And that's something we can definitely speak further about if that fact pattern applies to you and you'd like to reach out to your Sax advisor. But definitely we wanted to mention it on today's call as we start to roll into the new year and as a tax rate hike is on the horizon.
And Craig, there's probably like apps out there, right, that can maybe help people track this.
Yeah, so there's one specific app that's out there. I believe it's called Moneo, and what that does is it tracks folks' days in a given state. And that's particularly related to statutory residency. The one thing to highlight on that is states, particularly New York, have expressed that yes, they'll accept it as part of a submission and they'll take it into account, but they're really looking at other fact patterns as well, i.e. cell phone records, you know, Easy Pass records, travel records, credit card records, all that good jazz that kind of tell the story from a day count perspective. So when I speak domicile and when I speak statutory residency, the first hurdle to get over is domicile. The state wants to know that you broke your domicile, and what that means is whether or not you actually left the state that you have been calling home for all of these years. And there's certain tests that need to be met in order to meet it. And you know, items of near and dear, i.e. artwork and wedding albums and so on and so forth. business ties, family ties, all that good stuff where the state can kind of, you know, call you to the mat and say, yeah, no, you're still a domicile of this state, and even though you may be spending time in Florida or here or there, you know, you still intend to hang your hat, so to speak, in New York or in New Jersey or whatever, wherever the case may be. And then to Greg's point, statutory residency is the second test if and when you get over the hurdle of domicile, where the state says, okay, we'll buy the fact that you've now, you know, moved all of your important items, you've changed certain things, you know, most of your family ties, business ties are no longer in that state. Okay, you did what's known as breaking domicile. Now let's test you for stat residency. Were you in this state for more than a certain amount of days? Usually it's around 6 months, 183 days or so. If you go over that number, they got you, and you're pulled back in as what's known as a statutory resident, where now you're paying full freight to that state that you were trying to get out of. So key things to keep in mind. We're happy to have the dialogues with any folks who may be sitting on this fact pattern.
Great, thanks, Craig. So now we'll shift gears a little bit. First, we'll talk a little bit about portfolio allocation, how that can help you. So most people have different accounts, qualified or non-qualified. Qualified accounts are your tax deferred vehicles like IRAs, 401ks, 403bs, to name a few. Non-qualified accounts are your taxable brokerage investment accounts. At the end of each year, you get a 1099 tax form reporting any interest, dividend income, and then you have to report that income on your tax return and you pay tax. There's also a third maybe bucket, if you will, Roth IRAs. They may be the best vehicle out there because any investments in them grow tax-free. And if you take money out when you're retired from the Roth IRA, you'll never pay tax on that money again. And you can give it to your heirs when you pass away and they won't pay tax either. So it's important to kind of put certain investments in each of those accounts to minimize your tax impact. So for example, bonds, they pay interest income. That interest is considered ordinary income, which you pay at whatever tax bracket you are in. And that could be currently as high as about 37%. So by holding these bond investments in your qualified account, so your IRA, you're deferring the tax on that income until you pull the money out at retirement. Same with real estate investment trusts or REITs. That income is also taxed at the ordinary rates. Stocks and some mutual funds, they pay out dividends instead of interest, and sometimes those dividends are considered qualified dividends. Qualified dividends currently are taxed at long-term capital gains rates, which can be 0%, 15%, or 20% depending on your income. And you heard me correctly, if your income is low enough, you could pay zero tax on the qualified dividends. So that's why they are your friend. Those investments should be held in the non-qualified accounts since they are not taxed as much as those ordinary income items. Now, many mutual funds also pay out what's called capital gain distributions at the end of each year. It's really nothing that you can control as the investor. Throughout the year, those mutual funds are buying and selling assets inside the portfolio, and the distributions are payments to the shareholders for their share of the proceeds from those internal transactions. Now, a good part is that those capital gain distributions are taxed at the lower long-term capital gains rates. So potentially, again, maybe 0% tax or 15 or 20%. There's also tax managed mutual funds out there. They have a goal of minimizing the income payouts and minimizing your tax exposure. And lastly, there are exchange traded funds, ETFs. Those funds track indexes or sectors, commodities, or another asset. They tend to have lower expense ratios, fewer broker fees, and typically are more tax efficient. So if you're able to consider using these either tax managed funds or ETFs in those non-qualified accounts, that will also help keep down your tax exposure. Next slide, please. Now, with regard to your non-qualified accounts, at the end of each year, your advisor should be analyzing your holdings to see if there are any tax loss harvesting or tax gain harvesting opportunities. What are those? Tax loss harvesting is when you have an opportunity to sell a stock or a fund at a loss, and that's going to generate you an income tax benefit. You can use this loss to offset gains from other positions. And if you end up with more losses than gains in a year, you get to claim a deduction on your tax return of up to $3,000. Any excess losses and over that $3,000 is not lost. They get to be carried forward to future years to provide those future tax benefits or offset any future gains. Tax gain harvesting is a little bit counterintuitive. Why would someone want to sell a position that's in a gain and forcing them to pay tax? Well, there could be a few situations. Maybe that position is long-term capital gains, which is the lower rate, and depending on your income, like I mentioned a few slides ago, you could be in a 0% capital gains rate, so there would be no tax on you selling that position. Maybe on the flip side, if you have high taxable income from wages or K1 or other items, the most you would pay under the current laws is about 20%, plus the 3.8% net investment tax. Our government's recently been discussing getting rid of that long-term rate of 20% if you have higher incomes, but for now, that's not the case. Maybe there's a situation where a position is at an all-time high in value and you just want to make sure that you're locking in that growth. But lastly, the capital gain harvesting is an opportunity maybe to spread the tax out over more than 1 year. So say, for example, you know that you're going to need to sell a position in the future because you know you're going to need that money to live on when you're retired. Instead of selling it at that point in time all in 1 year and having the tax at once, maybe you can sell a little bit over the next few years to kind of spread out that tax over time. Next slide. Lastly, we got any strategies with your qualified IRA accounts. We talked a little bit about this. Craig enjoyed it earlier, but I'll kind of talk again. So IRA accounts have what's called required minimum distributions. You can take money out of your IRA beginning as early as age 59 and a half, but you're required to take money out once you turn age 72. The first year that you have to take your required distribution, you do have the option of delaying it until April 1st of the next year. However, that would mean that the second year you have essentially 2 distributions because all future distributions must be done by December 31st of every year. So you want to make sure if you've already received your distributions that you get them done before December 31st. Otherwise, the penalty is pretty high, 50% of that distribution if it's not taken on time. And again, Craig and Joy mentioned the qualified charitable donations earlier. If let's say you don't need to live off your RMD at all, but you still have a charitable desire, you could consider just giving your annual required distribution directly to those charities. Again, up to $100,000 would be allowed. It counts towards your annual RMD and effectively makes your RMD not taxable. So should you look into any or do any Roth conversions would be the last thing. Next slide. Roth conversions is when you take money from the traditional IRA, move it into the Roth IRA, you pay tax on that money in the year that you do this at whatever current tax rates you are at that time. There's no limit on the amount that can be converted to the Roth IRA, so it can be a pretty good strategy. What's the benefits? Well, it's going to reduce your future required minimum distributions because now you have less money in that traditional IRA bucket. Those Roth IRAs are not subject to required distributions. Theoretically, you're going to pay tax now at lower tax rates than in the future, where we would anticipate tax rates to go up. Like Joy mentioned, all the spending that's been going on, it's likely that taxes are going to go up. But for now, we're kind of have a stalemate. And then with the money now in the Roth IRA, your heirs would inherit that money tax-free.
Yeah, and just to kind of dovetail on what Greg was just saying, this is a good way to reduce the size of your estate. So it's basically a gift and estate tax-free benefit that you can give to your heirs by converting your IRA prior to death, so that you as the individual incurs the income taxes on that conversion, thereby reducing the size of your estate by that tax payment, and then creating a tax-free vehicle, tax-free income stream for your beneficiaries.
Hey, Greg, I wanted to quickly mention, I believe we had a question come in about this, but I also wanted to touch upon it when discussing charity as well. I wanted to highlight a little bit as it relates to land conservation easements. So this is a strategy that taxpayers have used over the years, in which they forfeit or give up, if you will, the right to certain lots of land, whatever it may be, and they give them to either land trusts or government agencies, or government entities, I should say, in which, where they no longer have the right, and they, promise, if you will, to not develop on that land, and they do what's known as conserve that land, if you will, and with that, coupled with that, has come along charitable deductions, so current year charitable deductions to the extent of 50% of AGI. So it seems like a home run. The one caveat and the beware that I'll throw out there is the IRS has been very aggressive in coming after these strategies in the recent years. There was actually within the recent bills a lot of language and jargon in there with regards to targeting that. And there was actually a specific section that's looking to go after it, because it's what the IRS sees as low-hanging fruit when folks try to do this. A lot of times taxpayers will get themselves tripped up on whether it's just appraisals that are way off base, and the IRS can challenge it, use their own appraisers and reduce the amount. And you're kind of at their mercy in that regard. They may come in and take a look, and sometimes there's been times where taxpayers have gotten tripped up and continue to kind of use the land in a way that they should no longer be using it. So there's a lot of instances in which this can get folks into trouble. The other thing I will add is, I wouldn't say that it's 100% guaranteed, but there's a pretty strong chance that if a conservation easement deduction is taken on one's tax return, it's probably going to end up flagging it from an IRS perspective and winning the audit lottery. Thanks.
Yep. So here's some other questions that have come in throughout our meeting. Do you have to wait 5 years before withdrawing any money from a new Roth IRA? Craig, you want to take that?
Yeah, so I believe the answer to that is yes.
Yeah. Now, however, I guess the catch would be if you've already had a Roth IRA set up and maybe you've done a Roth IRA a couple years ago, that 5 years started at that first conversion a couple years ago, and it doesn't reset every time you do a conversion.
Right.
Let's see. What do you think the odds are that we might see a change to the $10,000 SALT cap? Anybody want to take that?
I have no idea. I think that's I think that really the question is, what are the odds that there's going to be a Build Back Better plan even passed through Congress? And at this point, it's anyone's guess. The moderate Democrats are waiting for the CBO score on the plans that have been put forth. Presumably, when that comes back, there might be some modifications in order to, get the score to be. I think they're looking for something that's deficit neutral. So, I think we all just kind of have to wait and see. The SALT cap revisions are kind of a little bit of a game that's being played to modify, to massage that Congressional Budget Office number, at least in my opinion. So it'll be interesting to see. I think that's going to be something that probably would be movable, so that they can get the CBO score to be where they want it to be if they actually wind up passing anything.
Yeah, I think the one thing to emphasize with that also, Joy and Greg, is keep in mind many states have created their workarounds. You know, New York recently with their pass-through entity tax, and New Jersey most recently a year ago or so with BATE. So if you haven't yet started to take advantage of this, meaning getting a deduction at the entity levels and passing that on through, that's something that you should definitely, you know, speak with us about, or start thinking about if your facts permit.
Sure. Joy, here's a couple for you. What documents should be considered when planning out gifts, and is there any specific language to be mindful of?
All right, so I'm a trusts attorney, so I'm always going to tell you to make a gift in trust. I know people like to just, pass money or assets over to their kids directly. I think it's better and more efficient to do it through a trust, but maybe not in all cases. So what documents, what instruments do you need? If you are using a trust, you're going to need a trust agreement. And it's a really good idea to get somebody with an income tax background to review that trust, because if the Build Back Better plan does actually pass, it's got some pretty specific surcharges that are going to hurt trusts more than individuals. By way of example, if a trust has income over $200,000, that income will be subject to a surcharge of 5%. If the trust has income over $500,000, that will be subject to a surcharge of 8%. By way of contrast, under the current plan that's being considered, individuals would have to have $10 million and $25 million worth of adjusted gross income. So you can see that the levels are significantly different. When you are doing a trust under these circumstances, now that we're seeing what is being considered by the current Congress, you're going to want to make sure that you've got somebody with an eye for income taxes at the table.
Sure. Along those same kind of lines, is there any safe option available to give things away but still have access to them? And what if I need this money later?
The thing I love, the strategy I love the best is for married couples. And I mean, I actually was in a meeting and with a couple, and the husband said, "Oh, I guess I'm over married," because you want to have it in a stable long-term marriage. It wouldn't be somebody who's been married for 2 years. It would be more like somebody who's been married for 20 years. So somebody who is, quote, over married, in the words of my client, and that would be the Spousal Lifetime Access Trust. But again, it's really important that you understand that when you're putting assets in the trust, you're supposed to be giving them away.
Right.
But all of that said, you have the flexibility with a Spousal Lifetime Access Trust, we call them SLATs, where your spouse would have indirect access to the assets in that trust through your spouse. Basically, it's a, be nice to your spouse pact. If you ever needed something, you could say, honey, go take a distribution. The spouse takes a distribution, and then we all share it together. So that's the idea behind it. And certain other trusts, if you're not married, you can borrow from the trust at favorable interest rates. Perhaps there could be a tax reimbursement clause depending on which jurisdiction you live in. Craig spent a lot of time talking about different jurisdictions. New Jersey, for all of its tax woes, actually has favorable laws in this area. You can have a provision that would say, my trustee has the ability to make a distribution back to me for my tax burden arising from anything in this trust. So that would at least be a way that you could get some of that back. But ultimately, the best way to really get those assets back would be to set up some type of spousal trust.
Great. All right, last two, and I'll probably answer these. One is, they're kind of similar. how do I know if donating cash or appreciated stock is more advantageous? And then another one would be, should I do Roth conversions and how can I tell? Joy had mentioned this earlier, but what we do with our clients is we do tax projections each year. We can run different scenarios on whether you should donate cash or appreciate stock or do any conversions, and what impact those would have on you. A lot of those questions are more dependent on each individual person's situation. If you have a lot of appreciated stock, maybe that's going to be better for you. But like Joy said earlier, it's really, you should have these conversations with all your advisors working together, not just one certain person. That way, you're getting the best advice, for your situation. And I think that's all the questions I had. But if anyone else thinks of any questions, please feel free to reach out to one of us. You see our information up on the screen. We'd love to help you out.
And if anybody knows what Congress is going to do, definitely call us, because we really want to know. We appreciate it.
That's right. Thanks, Joy and Craig. Appreciate your help and input.
Absolutely. Thank you, Greg. Thanks, Joy. And thanks to all you folks who participated.
Thanks, everybody.